What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is August 7th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to spend some time to talk about an imminent collapse we see happening here this week in both Bitcoin and altcoin prices going into the next couple of months. A true reversal from the trend we've seen since back here in January 2023. I want to spend some time to talk about the key signs we're seeing both in Bitcoin and altcoins, as well as talking about the broader trend in the equity markets as well as commodities that not only point towards further downside for equities, but more upside when it comes to topics like inflation and macro concerns. We've got a lot of things to dive into in today's video. If you guys happen to enjoy my rambling here, whether you agree or disagree, consider dropping a like. It's one of the greatest ways you can support the content we create here on the channel. And let's go ahead and kick off the rambling. All right, I want to go ahead and start here with Bitcoin. While we have continued to maintain the blue trend here since back during the kind of mid flip here we had back in May, we've generally been holding this blue trend here on the weekly time frame since the flip we got here in January off of the 21% move we saw in the week of January 9th. However, we have continued to face stagnation here at around 30K, and week by week, we are proving that this is a range of distribution, a supply side range for price rather than a demand side. Essentially, there are more people looking to offload positions than really buy positions, and that market order sell side pressure is causing prices to stagnate yet again like they did in April. The problem here is that with our indicator, we are getting very close. If this week we close a mere few $100s below where Bitcoin is now, we are going to get that red flip. And I would say if we get about 2 weeks of red confirmation here, this is going to give us our ample opportunity to start building a short position in Bitcoin's price. It's not about getting the absolute bottom or the top of these plays. It's about waiting for the vital signs that showcase that the trend is ready to reverse. And it's not just Bitcoin here, guys. I'm not here to bash on crypto. It is what it is. We have to understand what's going on in the macro perspective here, because if asset markets aren't ready to kick off a new bull run, we need to be protective. We need to preserve our capital, or if anything, try to trade in the short term with where the trend is signaling it's going. And unfortunately for the bulls, the weakness over the past couple of months has been full enough proof here that we are ready to start moving to the downside. And if that's not enough, let's take a look here at what's going on in the macro scene. Now, a lot of people believe that the fight against inflation is over, but unfortunately, oil did something that completely countered the narrative that we've been hearing in the headlines and from most political or media pundits or economists that the fight against inflation is done. Oil, over the past couple of months, while it has been moving lower from its relative highs in March of 2022, we've essentially done something that many people unfortunately ignored. Many people believe that oil itself was done, that it couldn't move higher, and every single time we came down here to the 200 week, we pointed to people that essentially if we cannot break below the 200 week, don't be so confident that the fight of inflation is over, that oil can't spark up and kick off another rally. And while so many people got confident of that idea because we weren't closing above the 200-day moving averages or the blue lines we have here in our chart, and each time we kept retesting the 200-week moving average, everyone got ahead of themselves, and unfortunately, the unthinkable happened. Something we've again pointed to for some time in this channel, that we could break above that 200-day. And depending on which moving average we surpass first, that is going to let us know the next couple of months, the next year for the trend of that commodity. Essentially speaking, this means that oil could very well be on its way, especially if it clears through the resistance that's been held since November of 2022. If we clear through this range, we are likely going back to triple-digit prices. That's right. I'm talking about $100 a barrel for oil. That's going to mean your gasoline's going to be more expensive. Your heating at your home is going to be more expensive. Anything you can think of, petrol products that essentially come from crude oil are going to get more expensive. It is going to be more in demand here versus the available supply in the market, and that's going to drive prices higher. Unfortunately, spurring inflation higher and having a weighted effect across a whole range of other non-energy based expenses that you focus on in your day-to-day life and spend money on that go in towards inflation metrics. This is going to have to mean that the Fed will have to step in more tighter. And it's not just oil, it's also natural gas here. Natural gas has been forming a near year-long bottom here, about half a year since back in around February, and is now starting to turn prior resistance into descending support. allowing us to essentially start to get a higher bid here for the other energy-based commodity. And this plays a huge role in determining utility bills and the cost of your electricity. And if you think they're crazy enough as is right now, just wait until those commodity prices start coming back up. And this is why, again, we've hinted the idea that it's not good to take excessive risk during contractionary environments. There will be relief rallies. There will be periods of time where we'll say, oh man, I wish I would have invested in that. I wish I would have made that trade. But at the end of the day, if you're looking for a new bull market, if you're looking for something that you know for the next 5, 10 years, you can start to pack money into, take fiat that you earn from your job or from other activities and essentially put that into investments, enjoy the dividends, enjoy the annualized returns, then essentially speaking, that's a very different question. And we got to ask whether or not we're really in the environment for that. Have we dealt with inflation? That's the ultimate question. Now, we not only haven't gotten to the 2% target yet. So many people have already jumped the gun and said inflation is done with. Not only have we not gotten to 2%, but we need to get below 2% and we need to stay there for a prolonged period of time. Doesn't mean that just because we go below 2%, the Fed's just going to start pivoting and lowering interest rates. That's the narrative that so many people have unfortunately bought into. But if we take a look here at the Dixie, or the dollar index, since the decline we had here in July or mid-July, we essentially moved from around 100 on the index all the way up to 102.2. Again, at a moment where so many people were bearish on the dollar, we predicted that this would be a deviation in price, where essentially the dollar would start to move higher and come up towards our short-term target of 106. The significant reason the dollar is moving like this, and anytime the dollar is moving to the upside, it is essentially a way for foreign exchange markets to predict that the dollar is going to become more scarce, that the Federal Reserve is going to lead the way on monetary tightening, whether it be in the short term or long term. Essentially speaking, if we are seeing increased strength in the dollar, that means increased bets in financial markets that the dollar is going to become more scarce. The Fed is going to continue tightening. It's simple as that. And essentially speaking, if this starts to clear through some of these resistance lines that have been holding price, these are, by the way, descending lines of resistance, right? So it's much easier for the dollar to clear through here. If the dollar does clear through this range here, around 103, 103.5, that general range, that is going to spell bad news for the pivot crew, the people who believe that the Fed is just going to revert course and continue easing and stimulating financial markets. They have already paused essentially time and time again, yet continue to come back to having to raise rates even higher. And we can see here as well that the new expected current target rate, while it is currently at an 85% confidence of no change after the recent 25 basis point hike, there is already 15.5% of the CME Fed Watch tool betting that it's going to go up another 25 basis points. And I got to tell you guys, if you've watched this channel time and time again, if you come here and watch every single video Monday, Wednesday, and Friday, first off, I appreciate that. But outside of that as well, you will probably remember that we've watched the Fed Watch tool and time again. We revisit it sort of towards the beginning of the month and then the end of the month. And it always comes out that a small minority of people think that the Fed is going to raise rates. And then something happens. And then it goes to 30%. And then another thing happens. And then it goes up to 50%. And when financial markets continue to just rally the way they are off of lackluster fundamentals, it is one of the biggest telltale signs that the monetary system has been overstimulated, that essentially the Federal Reserve needs to continue on its course of tightening. That if financial markets are rallying the way they are, right, and we have this much excess money in the system and it's being proved for the performance of financial assets in the near term, during quite a weak macro environment and with tons of recessionary indicators flipping up, it's showing that there is a divergence from reality. And the Fed needs to extract that excess liquidity. And this 15% mark, I will bet you over the next couple of weeks, will probably move higher unless financial assets start to do what they're doing now. They continue to play out the way they are. This past week, we had the biggest surge in volatility since back in March of 2023. After coming down to record low levels that we haven't seen since back in February of 2020, right before the COVID pandemic. Now, I'm not saying it's about to repeat that chart. History definitely repeats to some, or doesn't repeat, but it certainly rhymes to degrees. Low volatility, incredibly low volatility historically in the near term and the long term, that is usually a sign for us to start getting cautious, to start taking profits if you've been long. And essentially get ready for some increase in volatility, some uncertainty in markets where they give up some of the gains and they start to provide better lows for new entrants. Now, why is this spike in volatility a big issue? Well, it's a reflection of what's inversely happening in stocks. As volatility moves up, stocks are starting to move lower. And the moves we got, Friday's close, are a big deal. What we got over this past week is not good for financial assets. And I'm not just bashing Bitcoin and crypto here. I'm actually more specifically talking about equity markets and the earnings season we've been going through at the moment. Now, some companies have gapped up. There are names like Meta or Facebook, and also names like Amazon that have gapped up on earnings, where the market has responded positively. However, many of those names have started to either chop sideways or roll over after their earnings reports. And most importantly, no matter if you are seeing one company that's doing good or whatever, you got to come back to the weighted market cap players. I'm talking about those that make up a huge chunk of the S&P 500 and the NASDAQ. Because if those market leaders that dominate in market capitalization are no longer leading the way forward, they are going to be a negative weight across the board for equities. It may not show immediately, but it will show over the next couple of days and weeks. Trust me on this. The key thing here to understand is that Apple, on its earnings report, while on the surface looks everything is okay, the surprise was actually positive, a slight beat on earnings from their estimate. So what's the problem here? Well, the problem is that people, as always, investing in stocks are really investing in two things. They're investing on future earnings, and therefore, sort of in the same fashion, they're essentially investing in future growth. Apple itself, alongside so many other stocks, were seen as these great growth plays over the last decade. And because of that, people have started to pay a higher price to earnings multiple. But if these companies are not accelerating, if they are not growing at the same rate they were over the last decade, and in fact, maybe starting to see stagnation in some of their most profitable ventures, and are not seeing so much adoption or buy-side pressure for a lot of their new products, like for example, the Apple Vision Pro, these new bets that they're investing a lot of money in, right? If essentially Apple's not the AI play that many people thought it was, well, it's going to drop respectively. And it dropped 4.8% after already a 3-day losing streak from its price target around right under $200, around $196 per share, down towards $181.99. This is the biggest move Apple has made in months. It is bigger than some of the moves we saw back here on a daily time frame, like back in November of 2022, or back here as well during August of 2022. A 4.8% massive gap down after an already 3-day losing streak for Apple. This is not a good look, because if you really want to understand the weight and ramification of a 4.8% move, it's kind of easy to get lost, right? Because if we think about Bitcoin makes 4.8% moves, not a big deal, upside or down, doesn't really matter. Your favorite altcoins might make those kind of moves. Even, stocks you might be trading in and stuff in the equity markets might make those moves pretty, commonly. Why is that such a big deal? Like Apple, come on, it's a titan of a company. Well, because it's a titan of a company, a 4.8% move is essentially, in the current valuation terms for Apple, is a near $300 billion wipe off the map here. A huge move over the past couple of days. So essentially speaking, let's go ahead and just take a look here, right? From the hourly time frame, coming from around a near $3 trillion valuation, we came down to 2.72 trillion. Now, if you compare that to where we were back on July 28th, we were sitting around a $3.13 trillion market capitalization. So essentially, $400 billion have been wiped off the face of Apple's valuation. Not a good look. And if people think for a moment that that doesn't have a weighted ramification on the investment perspective in other companies, that it doesn't make people think twice about taking more risk in other plays and essentially maybe cashing out and taking out some good profits from the positions they've built over the past couple months, we may have another thing coming to us. We've got to be aware of the reality, the psychological effect of Apple gapping down like this and buyers not coming in, but rather sellers continuing to drive down prices. We need to also take a look at the long-term charts here and get back to the weekly and monthly time frames. And this is the big topic I want to hint on here, guys, because essentially speaking, it's one thing if Apple and all these companies just have a bad earnings report, or the market doesn't like the result and prices move down 10 or 15%, and then buyers start to come in and drive things higher. That is what you would find in a bull market. However, If Apple and many of these technology plays that have been leading the way forward in regaining valuations since the bear market that we were going through in October of 2022, essentially speaking, if we do not hold on some of these, again, price targets, which give us plenty of room for buyers to come in and potentially formulate support, if we start to crack through some of these ranges of prior resistance yet again, this will be a giant deviation in price. And that is essentially going to mean that instead of finding support here, if we crack below that range, it will start to act as resistance and we start moving back towards long-term lines of support, like the one that has been holding Apple's price up since June or July of 2013, and also the descending line of support since back in November of 2021, which would take Apple down to $90 a share. Now, I want to put that in perspective here. If Apple goes down to $90 a share, that is going to be wiping off, from current valuations, $1.4 trillion. Yikes. What kind of effect would that have on not only other stocks, but most importantly on Bitcoin? If Tesla can't hold above its breach on the line of resistance, if it got ahead of itself, and this starts to act as resistance, similar to how it was back here, we essentially are moving down to the lower end of the expanding funnel. We are going down to the descending line of support, as we've talked about for months, a full 90% correction in one of the best growth stocks of the last decade. It's not me bashing Tesla, it's not me bashing Elon, it's just me pointing out the price action here. Growth names like this usually give up a lot of their gains, and unfortunately they are not going to be the plays that many think are going to continue leading the way. Previous market leaders tend not to be new leaders in new bull markets. If we are in a new bull market, I gotta tell you guys, Tesla and Apple, how are they going to 5 or 10x over the next couple of years? Let's be realistic here. These are trillion-dollar companies. I know Tesla is technically a couple $100 billion, as a company, already priced quite high, even considering its earnings, right? Apple being at a $2.4, $2.5, $3 trillion company valuation, right? How is that gonna 3 or 5x over the next couple of years? We've got to be realistic. In a tightening environment, that just cannot happen. Netflix here as well. Take a look at this weekly candle after a huge move higher here over the past year, since back in May of 2022, one of the first FANG stocks to get hit the hardest, but also start recovering as early as possible. Here in July, just huge negative reaction to earnings, which is again starting to show signs that it's rolling over here. And we can see that Netflix, again, we have to ask ourselves when we're looking at these names, whether or not it's a growth name anymore. Can we continue paying the same kind of premium for Netflix? Is it going to continue growing like it did over the last decade? Fortunately, it's not going to. And we have to take a look here at the last standing name in equities, NVIDIA. Now, NVIDIA probably won't make as substantial as a move as some of the other plays to the downside. It might cool down a little bit here, but we have to wait for NVIDIA's earnings, which come later this month in August. And perhaps that might be one of the serious catalysts that let us know that the one narrative that is almost like a twig holding up a pile of books at this point, the one narrative that people are grasping onto, AI, that AI is just going to save us. If that cracks, if NVIDIA's quarterly guidance increase that they set, going from 7 billion expected revenue to around 11 billion, doesn't actually come through, or maybe it's a fluke, it's a one-off event, the markets got ahead of themselves, not only will there be pain for NVIDIA, it comes back here to the central topic, there will be pain for Bitcoin. Bitcoin has not been showing up to the plate over the past couple months, folks. We've got to be honest with ourselves here. This prior range of significant support in the past is now clear resistance. After all of the narratives we have been told over the past couple of months, the Bitcoin bank run did not play out, right? Stablecoin liquidity in the space has continued to dry up. There's no massive retail or institutional buying of Bitcoin, right? Outside of MicroStrategy, of course, which is coming in and just, again, trying to swallow up as much Bitcoin as it can get, right? De-dollarization. Well, again, we come back to the dollar here. Dollar certainly has been on a decline if you want to take a look back since September of 2022, but it really hasn't moved since the start of this year. So BRICS and all those narratives, not holding up so much. Now, of course, people will say the Bitcoin BlackRock ETF, that's going to save it. Well, again, we have to see if that's going to happen. I got to be honest with you guys, if I'm looking at BlackRock's price performance, it's not pointing to that. BlackRock, again, as a company, divided by XLF, this is the broad financial sector, we should be expecting BlackRock's going to dominate this market, that it is making serious moves against the broader financial sector, and it's not doing so. It's walking in lockstep with traditional, archaic banks and financial institutions. And when you start to look at Bitcoin's lackluster performance here over the past couple months here, since we had really great trend acceleration clearing through those moving averages back through January to March, we need to see whether or not we're going to be able to hold on that 200-day, which is caught up here with price. Whether or not we're going to be holding on that 200-week. Whether or not our indicators are going to be able to tell whether or not the bull market momentum is here, supposedly, as so many people are betting on. And we have to see whether or not Bitcoin is going to hold in this price range, this ascending channel, because if it doesn't, if we come back out of this previous lines of support, or this previous range of support that's now resistance, if we break through the ascending channel here, if we break through the moving averages and our indicator flips red on the weekly time frame, and also on the monthly time frame, why go long now? Why not wait for serious signs that the market is ready to hold up price? That's the point I keep coming back to, guys. And again, take a look at altcoins here. We called it the other day, right? Essentially speaking, altcoins collapsed through their line of support. We have essentially given up all but $5 billion worth of gains from the XRP news. The supposed case that XRP won, right? And again, if you want to take a look specifically at XRP, I know I got a lot of crap from people that I was saying that you should not be buying into this rally and that it's not a guaranteed slam dunk, and that there are clauses where, in the case they did define that the secondary sale of cryptocurrency, while that might not be an offering of securities, it's one court ruling, and outside of that as well, it doesn't mean that it's precedent forever. And we also have to consider the first clause, which is that the initial offering was definitely seen as a security in the court's case. Now, look, I don't really have a strong opinion on this. Not here to bash XRP, but take a look here. Common pump in price here for XRP, as always, and a continued slow distribution, a dump in price over time. I hate to be negative, guys, but I hate to see people losing money. I hate to see people saying that this was a paradigm shift for crypto. There were so many people saying that back then, and we were one of the few voices out there among another great pool, I think, of content creators who are essentially trying to get people to be more grounded in the space. Because you can end up losing your shirt buying these pumps off of FOMO, believing the idea that it's just guaranteed to be a bull market. In the meantime, guys, we've been talking about the idea of preserving capital. We've talked about stacking cash in the meantime through your job, through your savings, getting ready for the real capitulation event. And one of the things that is important for you to understand is it's not just important to essentially have that capital on the sidelines, to not chase every single move, but to be prepared in the right platforms that are going to give you the tools to be able to go out there and make those moves whenever they're ready, whenever it's time to strike. One of those platforms that I want to spend some time to talk about is one of our partners here on the channel, and that's Kraken. But more specifically, I want to talk about Kraken Pro. Now, this is one of the exchanges. I'm someone who's been kind of using Coinbase Pro for a long time. I've used a couple of other different exchanges. But for me personally, I'm getting really psyched about what Kraken recently launched. Kraken is a titan in the industry. I mean, if you're worried about security after the last year of disappointments in the crypto space, I got to tell you guys, Kraken is the most secure player in the industry internally and also for users as well. They are one of the top exchanges if you care about security of custody and also your login and user experience. But outside of that, Kraken Pro specifically as a platform has gotten really good. It has a whole range of different features and tools you're not going to get on platforms like Coinbase Pro or Binance. For example, one of the really great things here is that you not only have all your core functionality where you can do spot and also margin trading depending on which jurisdiction you're in, but outside of that as well, you have analytics here. So you can access a whole range of important data on various market pairs. So for example, we can see in this case, the trade count is falling off the cliff here for Bitcoin right now. We're not seeing a lot of daily trades here. Volatility has remained relatively low here in price. We can see trade volumes, the order book, imbalance, and slippage that would be caused depending on buy and sell side pressure and also the rolling volatility. These are a lot of really solid metrics that can help you to make decisions here. And I think, again, tell a really great story about what's really going on in the market now. We are not seeing some massive acceleration of trading volume. We are seeing practically no retail volume right now in the market. No serious substantial retail activity, the lowest level we've seen since October of 2020. You're not going to get these kind of insights on a whole range of other exchanges out there in the market. And this is, again, why Kraken Pro is so great. It offers these tools right from within the interface for no additional cost. You can also check your portfolio, which will give you a broad range of your actual portfolio, whether it be fiat currencies that you can deposit a whole range of, as well as different types of crypto assets. As you can see at the moment, we're in cash. As we're waiting for that dip opportunity, we're going to be adding more into the account here as time progresses. And outside of that as well, there's a whole range of different cryptocurrencies that you can trade, whether you're trading spot or margin. Essentially, there's different categories such as DeFi tokens like Compound, Aave, Synthetics, and Maker, as well as Uni. And there's also layer 1 and layer 2 plays like Bitcoin, Ethereum, Solana, XRP, Bitcoin Cash, and also layer 2 plays like Matic. So we've got a whole range of different categories and cryptocurrencies to trade with deep liquidity. Kraken, again, being one of the largest exchanges, is going to offer you not only some of the best fees, but also as well some of the best liquidity in order to avoid excess slippage when making trades. And with that as well comes with the functionality and tools that you need to build the best experience possible. And if you're building long-term positions, as we talked about earlier on this concept of a bull market, preparing for buying for a bull market dip, they also have staking features, which unfortunately are not available in the United States, as I'm a US user. But it is something that, again, if you're international in a whole range of jurisdictions, you can check and see whether or not staking is offered to you as an individual. So that's it here when it comes to Kraken. There's a whole range of things like the built-in TradingView interface where you can actually utilize this for your technical analysis, activate a whole range of traditional indicators that you're already utilizing within the TradingView suite. But outside of that as well, you can do all your TA and navigate through its whole range of different panels here, such as your market favorites, switching between various plays, and access all the major trading features you've come to know, love, and expect, as well as more that you just can't get from other exchanges. So I definitely recommend you guys check out the link down below in the description for Kraken Pro, but that'll be it here covering Kraken as a platform. I want to spend some time to come back here towards this macro topic, guys. We not only have a real concern here of inflation coming back into the picture, but outside of that as well, we've got to simply talk about the dynamics of market dominance when it comes towards plays in the market. Now, you all know we've talked about Bitcoin dominance before and how that can signal the risk on and risk off mentality of markets, right? When altcoins generally make up a large portion of the market, the risk on mentality is strong. And vice versa, when Bitcoin dominance is strong, usually Bitcoin essentially is a signal that there's a risk-on mentality. Well, there's another way to look at this when it comes to equity markets, a little bit flipped on its head. Essentially speaking, there is concentration of liquidity and returns into a few key plays. And those plays have been the two technology giants, Apple and Microsoft. Now, this chart I'm about to show you guys is one usually we only share to members of the Dash Report, but I wanted to give you guys a little taste of some of the analysis that we do within the Dash Report. Essentially speaking, this is a custom ratio where we add Apple and Microsoft and we divide that by the S&P 500, the performance of the 500 top stocks in the market by market capitalization. Now, if we consider this here, this ratio, we essentially see that in the long term, especially during the decade of growth, we see that Apple and Microsoft really over the past couple of decades have been technology giants in their own right. They had a period of stagnation here for around 17 years, but then continued that growth trajectory similar to what they did back in the 80s and the 90s. As I mentioned here, previous market leaders tend not to be the new leader in the next bull market. There were bull markets during this period of time, but as you can see, these were not the plays that were outweighing the S&P 500. Only until 2017 and beyond did these plays start to accelerate. But I want to focus here on the short term, because no matter if you were sold to the idea here that we are still in a bear market or that we are, in a bull market, but we need to have some kind of correction, it is practically inevitable at this point that we are expecting some kind of cool down. Take a look here at the ratio. Time and time again, we've come up here towards this ascending line of resistance. And it looks like we are yet again going to enter in towards another 9 to 12 month period where these technology plays that so many believe are the market leaders are likely going to cough up a lot of those gains. And I gotta tell you guys, let's take a look at these time frames. December of 2021 to January 2023. And you think back to how Bitcoin performed during that period of time? Not so well. Because the weighted effect of equity markets does have an impact on crypto. I know people like to think that it's completely asymmetric. We like to think more idealistically that Bitcoin is separate from everything, but unfortunately liquidity is tied together. And that means that as Bitcoin is a big boy market now, crypto assets are more than $1 trillion in total market cap. That contracting liquidity and contracting sentiment on equities is going to hit crypto. It didn't really lift it up much over the past couple months, but boy, it will bring it down big time. We already saw that back over the last year, and it will likely continue to play out here in 2023 and 2024. I hate to be the bearer of bad news, guys, but right now it's about stacking liquidity and waiting for that moment to strike, waiting for the time where real capitulation comes in. And unfortunately, people have not learned the lessons of the last few years. People are still getting leveraged in this space. They're still building up huge positions, borrowing in order to speculate, right? And we're unfortunately just seeing the same names, if anything, coming back into the space, not new entrants. And that does not formulate a new bull market. And no BlackRock ETF is going to save you from that. I'm only telling you guys this here not because I want you to go out and use my referral link to leverage trade or to go out there and take excessive risk. I'm telling you this because I want to be your friend, and I want to let you know that, even though maybe it's against my own financial self-interest, I have morals, and I want you guys to preserve and protect your capital more than anything. You worked hard for your money, and you should listen to those who most importantly understand that that is the number one step in order to maintain financial freedom long term. Don't get caught 2 steps behind. Don't lose out when you could be preparing for an opportunity down the line that can help you win out big. Anyways, guys, I rambled on a good amount here today. It's a long video. I hope you guys enjoyed this video. If you did, consider dropping a like. And if you made it this far, consider as well signing up for the Dash report. If you liked that Apple, Microsoft divided by the S&P 500 ratio, you get access towards a whole range of really cool insights and analysis on financial markets, crypto, but also equities and commodities and Forex, all within a 20-page plus report each month for the Dash report. And you also get access towards our mid-month webinars where you can ask me questions. You join into our Dash report discussion group where you can talk to hundreds of other members of the Dash report, and you also get access towards our market alerts when we make trades in the market. But that's it for today's video, everyone. Thank you all so much for watching, and I'll see you all in the next video. Take care, everyone.